In 1846, Britain poured an astonishing £40 million into railway schemes, a sum equivalent to roughly 7% of its entire national income. Within a year, much of that investment would evaporate, leaving a trail of bankruptcies and shattered dreams. How did an entire nation become so enthralled by iron and steam that it risked financial ruin? Before the railway age, Britain's burgeoning industrial revolution relied on a patchwork of canals and horse-drawn wagons. Increasingly inadequate for the demands of expanding mines and factories, the invention of the steam locomotive by pioneers like George and Robert Stephenson promised a revolution in transport, offering unprecedented speed and efficiency. The opening of the Liverpool and Manchester Railway in 1830 showcased the immense potential, transforming travel and commerce. This period of innovation coincided with a loosening of financial regulations, particularly the repeal of the Bubble Act, which opened the floodgates for public investment in joint stock companies. The stage was set for an unprecedented economic phenomenon. This matters today because it offers a stark parallel to how disruptive technologies can ignite speculative frenzies, even in seemingly rational markets. To understand how this worked, we must delve into the financial mechanics of the Railway Mania. The core of the frenzy lay in the speculative trading of railway shares. Companies would offer shares, often requiring only a 10% deposit, with the remaining 90% callable at any time. This created immense leverage. Investors could control a large number of shares with a relatively small outlay, amplifying both potential gains and catastrophic losses. As railway shares soared, fueled by optimistic projections and aggressive promotion, many investors from the burgeoning middle class to prominent figures like Charles Darwin were drawn in, convinced that railways were a guaranteed path to wealth. This was further exacerbated by the rise of powerful magnates like George Hudson, known as the Railway King. Hudson, through shrewd acquisitions and often questionable financial practices, consolidated vast railway networks, further inflating the perception of invincibility within the sector. He epitomized the entrepreneurial spirit of the era, but also its speculative excesses. The regulatory environment was minimal. While parliamentary approval was needed for new lines, there were few checks on the financial viability of the countless proposed schemes. Many members of parliament themselves held railway shares, creating a clear conflict of interest that allowed impractical and even fraudulent projects to gain traction. The asymmetry was clear. Insiders, like Hudson, understood the precarious financial structures and the true risks, while ordinary investors, blinded by the promise of quick riches, often did not. They assumed the growth was sustainable, that the calls for the remaining 90% would never come, and that the railway boom was an unstoppable force. This assumption proved to be their undoing. The human cost of this mania was profound. For many, the railway was not just an investment. It was a symbol of progress, a tangible link to a brighter future. Families mortgaged their homes, artisans invested their life savings, and even servants pooled their meager wages, all hoping to secure a piece of this seemingly boundless prosperity. Contemporary accounts describe a pervasive optimism, a collective belief that the railways would transform Britain and enrich everyone who participated. However, this widespread enthusiasm also made them vulnerable. When the inevitable crash came, the consequences were devastating. Letters and diaries from the period revealed stories of destitution, despair, and shattered trust. The collapse wasn't just a financial event. It was a social upheaval that exposed the fragility of newfound wealth and the harsh realities of unchecked speculation. Many who had once dreamed of prosperity found themselves facing ruin, their hopes derailed by the very engine of progress they had so eagerly embraced. The climax of the railway mania arrived swiftly and brutally. In 1845, the Bank of England, concerned by the overheating economy, began to raise interest rates. This seemingly minor adjustment had a cascading effect. Higher interest rates made borrowing more expensive, squeezing companies that relied on credit for construction and expansion. Simultaneously, it made government bonds more attractive, drawing capital away from speculative railway shares. The market, already stretched thin by overvaluation and unrealistic projections, began to falter. The index of railway shares, which had doubled in 2 years, topped out in 1846 and then plummeted by approximately 50% between 1846 and 1850. The real blow came when companies, desperate for funds, began to issue calls for the remaining 90% on partly paid shares. Many investors, having spent their initial 10% deposit, simply did not have the capital to meet these demands. Bankruptcies soared, projects were abandoned, and the landscape became littered with half-built lines and the wreckage of financial dreams. Nearly a third of the lines authorized by Parliament were never completed, a stark testament to the irrational exuberance that had gripped the nation. Despite the immediate devastation, the Railway Mania left an undeniable and ultimately beneficial legacy. Unlike many speculative bubbles that leave little of lasting value, the mania inadvertently accelerated Britain's railway network development. The sheer volume of track laid, even if some projects were ill-conceived, provided the foundational infrastructure for a modern industrial nation. Many of the initially failed lines were eventually absorbed and completed by larger, more stable companies, becoming vital arteries of commerce and communication. This episode offers crucial lessons for today's financial landscape. The parallels to modern speculative bubbles, whether in dot-com stocks or emerging technologies, are striking. The allure of disruptive innovation, the ease of investment, the minimal regulation in nascent markets, and the pervasive belief in ever-increasing returns. These are all echoes of the Victorian railway mania. It reminds us that while technological progress can drive genuine economic growth, it can also create fertile ground for irrational exuberance and speculative excess, often at the expense of ordinary investors. In conclusion, the railway mania was more than just a financial bubble. It was a transformative period that reshaped Britain's physical and economic landscape. It demonstrated the immense power of capital and innovation, but also the inherent dangers of speculative fever. The legacy of the railway mania is a dual one: a nation irrevocably changed by its railway network, and a cautionary tale etched into the annals of financial history, reminding us that even the most promising innovations can lead to ruin when speculation outpaces reality. The Victorian bubble may have broken a generation, but it also built the foundations of a modern nation, a testament to both the folly and the enduring impact of human ambition.